My name is Ed Peters, and I'm a director in the real estate tax team at BDO. The purpose of my presentation is to discuss the wide-ranging changes that have been introduced to the taxation of capital gains or disposals of real estate by both non-UK and UK tax residents. These changes were effective in April 2019. It is therefore important for all property owners to have knowledge on how the new rules may impact them. To the extent there are any questions, please do contact me after the webinar and I'll be happy to assist. To give some background on the changes, prior to April 2019, the position on capital gains arising on the disposal of non-UK real estate was that, subject to a few specific exceptions, such as real estate investment trusts or REITs, all UK tax residents were subject to tax on capital gains arising to them, and non-UK tax residents were exempt from UK tax on capital gains, other than those arising in connection with residential real estate. From April 2019, the general position is now that UK tax applies to all real estate disposals, companies being subject to corporation tax on such gains, and other taxpayers to capital gains tax. The new charge applies to both direct and indirect property disposals. Therefore, in the simple scenario covered in this diagram, both a direct disposal of the property by the non-UK PropCo and a sale of the shares in either the non-UK PropCo or the non-UK holdco would now generally be subject to UK tax. That being said, the rules were introduced with the intention of taxing only economic gains arising after the new legislation was introduced. Therefore, all non-UK resident owners of commercial real estate are entitled to benefit from a rebasing of their property interest for capital gains purposes from 5th of April 2019. This rebasing applies to both property and share disposals. To the extent it produces a better outcome, taxpayers can also elect to use historic cost for their capital gains calculations, although there are some restrictions in the use of historic cost for share disposals. It's also important to note that residential property is rebased to 5th of April 2015 rather than 5th of April 2019, although shares in companies which own residential real estate are still rebased to 5th of April 2019. There's no formal requirement to actually obtain a valuation. However, as for other similar tax valuations, such as Market Value 82, it would generally be preferable to have some formal support for valuations used in the event of inquiry. It's important to be aware that one exemption from the new charge applies on share disposals. If a shareholder owns less than 25% of a company, including shares owned by their associates such as relatives, there is an exemption from the charge. However, this does not apply where a company invested in is a collective investment vehicle. I will cover collective investment vehicles in more detail now. After the changes outlined in the previous slide were announced, HMRC underwent an extensive public consultation process. As a result of that consultation process, further legislation was introduced concerning collective investment vehicles or CIVs. The purpose of the CRV legislation was to relax the new capital gains rule charge in certain circumstances and to clarify particular technical issues created by the new rules. A collective investment vehicle is, broadly, any collective investment scheme within the usual FISMA definition, an alternative investment fund or AIF, a UK REIT, or a non-UK resident company which is exempt from tax in its jurisdiction of residence, distributes 90% or more of its income, earns more than 50% of its income from long-term property investments, and is diversely owned or non-closed. This final category of CIV is intended to capture non-UK REITs, but also extends to a wider range of property investment structures, such as Channel Islands companies. It will be clear from the description of entities that can qualify as a CIV that the definition is wide, and many property investment structures will fall within these rules. Likewise, certain structures, such as companies resident in the UK, may not fall within the rules, even if they have a diverse pool of investors. We now come on to an explanation of why these rules matter. The CIV rules, as noted above, provide a number of modifications to the general capital gains rules concerning the taxation of UK real estate. The first modification concerns so-called hybrid entities. These are entities such as property unit trusts, which are treated as transparent for the purposes of tax on income, but have historically been treated as companies for capital gains purposes. Historically, the fact that property unit trusts were treated as companies for capital gains purposes was largely irrelevant, as the UK would not ordinarily tax capital gains on the disposal of assets by non-residents. However, with the introduction of the new capital gains rules, concerns were raised that the extension of UK capital gains taxation to non-residents meant that additional layers of tax were going to be created within property unit trust structures. As a result, HMRC have introduced a regime which enables hybrid entities, such as property unit trusts, to be elected to be treated as partnerships for UK tax purposes. The practical impact of this election is that additional layers of tax are eliminated for elected hybrid entities, meaning that their investors pay tax on income and gains arising to them as if they're arising to them directly. The second modification concerns the 25% de minimis referenced above for disposals of shares, as set out in the scenario on the right-hand side of this page. Where a disposal is made of shares in a CIV, or in a case where a disposal has an appropriate connection to a CIV, the gain is automatically taxable, irrespective of the amount of shares that are held. Practically, this brings all investors into CIVs into the scope of UK capital gains taxation, however little the investment they hold is. The final and most important modification that the new rules have introduced is a CRV Exemption Election. I will discuss this in detail as it's complicated and has some very important implications. To qualify for the CRV Exemption Election regime, the structure in question must fall into two broad categories. Firstly, if a company is owned 99% or more by partnership, it is capable of qualifying. This is seen in the first diagram on this page. The company in question can be either UK or non-UK tax resident. Secondly, a non-UK REIT or REIT equivalent structure can also qualify. This is seen in the second diagram on this page. For the purposes of these rules, a property unit trust would also be capable of qualifying. Under this element of the test, the CAV itself must be non-UK tax resident, although the underlying property companies themselves can be UK tax resident. In both cases, there's a further requirement that the structure in question is diversely owned, as well as other general conditions such as the fund being UK property rich. For those of you familiar with the terminology, this requires the structure to be non-close. A close company is broadly a company the equity in which is owned 50% or more by 5 or fewer shareholders. This means at least 11 independent investors are required to qualify for the regime. However, it's important to note that certain institutional investors are not counted for the purposes of this test. Therefore, even if a structure has only a single institutional investor, it is capable of electing into the CIV exemption regime. The definition of an institutional investor is complicated, but categories of investor that can potentially qualify include pension funds, insurance business, sovereign wealth funds, and governments and charities. It's important to note that one possible downside of electing into the exemption regime is that there are certain reporting requirements. These include the reporting of investors by the elected fund and reporting of capital disposals within a fund. The benefits of electing into the exemption regime are that direct property disposals and disposal of shares within an elected fund are exempt from UK capital gains taxation. In the diagram shown, this would mean that, for example, any disposal by or in a propco or a disposal of a holdco would be exempt from UK tax. Furthermore, in most cases, where a propco is sold, real estate held by that propco is rebased. The practical impact of this is that any capital profit within that propco disappears for tax purposes. This potentially makes COV propcos attractive to purchasers. It's important to note that this exemption regime applies irrespective of the residence of the companies within the fund. Therefore, there will now be structures where UK resident companies, which were previously taxable on capital gains, will be able to benefit from an exemption from UK tax on capital gains. In general terms, the impact of the CRV exemption election is to give elected structures equivalence with UK REITs in terms of the tax treatment of capital gains arising to them, as UK REITs are also exempt from tax on capital gains. The downside of electing into the exemption election regime is that capital gains which have been exempted within a fund are taxable to the extent they're distributed out of a fund or on, for example, the winding up of a fund. There are also anti-avoidance rules to stop the extraction of gains out of a fund in a non-taxable form. Therefore, the regime will usually only be beneficial where the intention is to roll up capital gains within a fund regime and only distribute income on an annual basis. This means it's important to assess on a case-by-case basis whether electing into the regime will be beneficial or not. However, an important exception to this is structures in which the ultimate investor is an institutional investor. In those circumstances, distributions from the structure are often also exempt, providing a full exemption from UK taxation on capital gains. In addition to the CRV Exemption Election, a further exemption was introduced for trading structures with significant property interests. This exemption was introduced with the aim of providing capital gains exemptions for so-called opco-propco structures, such as that depicted in this diagram, whereby property ownership and trading activities are segregated into separate structures. This structure is common with particular asset classes such as hotels and student accommodation. Without an exemption, in this scenario, a disposal of the propco would be taxable in the UK. However, if certain conditions are met, the trading exemption exempts the disposal of the propco in such structures from capital gains taxation. The capital gains status of the propco itself is unchanged. However, the exemption only actually applies if the propco and the trading operations are sold together. This means that in many cases the exemption may not be available in practice. It may therefore be better to rely on the substantial shareholding exemption instead, as this provides a more flexible exemption. To recap on the content of this presentation, UK capital gains taxation has been extended to all owners of UK real estate wherever resident. However, a number of potential exemptions have been introduced, including the CIV Exemption Election regime and the trading exemption. These exemptions can be full or partial depending on the exact structure of an investment and the nature of investors. Therefore, going forwards, it's important to always consider which exemptions, if any, are or may be available to exempt capital gains arising from UK real estate disposals. These exemptions can be available even for UK tax resident structures.